Hi, everyone. This is America Adapts, the climate change podcast. Hey, Adapters. Welcome back to another exciting episode. Returning to the podcast is Dr. Carolyn Kousky of the Environmental Defense Fund. Carolyn is a regular on the pod, and she's returning to discuss a new report she has out looking at insurance markets in the state of Florida. She shares how Florida faces significant economic risks due to hurricanes and other extreme weather events we can expect with climate change. The episode delves into the complexity of the state's property insurance system and the absurdities in those insurance markets. Carolyn addresses Florida's reliance on smaller insurance companies, the critical role of reinsurance, and the impact of climate change on insurance pricing and availability. I've covered Florida quite a bit, and I thought I knew a thing or two about insurance in the state, but it was like going behind the curtain with Carolyn as she shared the results of her report, which led to a larger discussion about property insurance in the Sunshine State. This was a fun and an enlightening episode for me. I hope you enjoy it. Now let's join Carolyn and understand property insurance in Florida in the age of climate change. And stick around for this episode's hot take. Hey, Adapters. Today I have a very exciting episode. Returning to the podcast is Dr. Carolyn Kousky. Carolyn is the Associate Vice President for Economics and Policy at the Environmental Defense Fund. Hi, Carolyn. Welcome back to the podcast.
Hi, Doug. It's so great to be talking with you again.
You are such a regular on this thing. But for those who have not listened to any of your episodes, just ground us a little bit. What is EDF and what do you do there more broadly?
Yeah, so I work at the Environmental Defense Fund. We're a global environmental organization. I've been there for the last 2 years. Before that, I directed a risk management center at the University of Pennsylvania. I sit in our economics research team, so I continue to do research and policy analysis on climate risks and how we're managing them.
You have a new report out, and we're going to talk about that. But just very quickly, your last episode with me, you brought me in to cover this. I think it was just a climate risk and insurance conference that occurred in DC. And it was a very popular episode. I hear a lot of feeding people out. My listeners are all just a bunch of wonks, but they enjoy these things. Is there any plans to have a follow-up conference in the year ahead?
Not yet, but I appreciate you saying that. And I think there was so much great discussion and exciting ideas coming out of that. We're still trying to figure out the best way to not lose momentum and keep going on some of the potential innovations and policy reforms and other things as the crisis in our insurance markets doesn't seem to be letting up since climate risks keep growing is almost better than anyone.
Yes, indeed. And again, the feedback, I enjoyed doing it, but just the feedback, I really enjoyed it. And they just learned a ton because there were so many voices in that. So just some feedback. There's a demand out there for that kind of stuff. All right, we're going to pivot here. And you have a new report that's out and it's called or entitled The Evolution of Florida's Public-Private Approach to Property Insurance. And I invited you on because I saw that and I'm like, all right, insurance in Florida. And I'm always talking about Florida on the podcast. First off, can you just give us the 30,000 foot view? I think you have a co-author and like the history. Why did you do this report?
Yeah, I did this report, yes, with my co-author, Lori Metters, who's long been thinking about the Florida insurance market. So it was great to collaborate with her. And it was put out by the Florida Policy Project. They're a new think tank in Florida. And one of the issues that they think about is insurance. And we got some great advice from them and their board members as well. And why Florida? Florida is in some ways ground zero for what's going on in our insurance markets. And their market has been in a state of turmoil the past few years, more so than even usual. So we wanted to, with this report, just ground people in the dynamics of what is happening with Florida and just be clear about what the issues are and what's going on. And am I right, Doug, in remembering that you're from Florida? So you have some personal attachment to the state as well?
Grew up in Florida. I go there. I have family there. And I'm always talking about Florida. Yes, I'm a Floridian, even though I'm living in Arizona right now.
Got it. Your family might be experiencing some of this firsthand then.
Yes. And you alluded to it there, but can you ground us a bit more about not a comprehensive history of insurance in Florida, but tell us a little bit about how things have unfolded. And as you said, they've gotten really bad in the last few years. What has this roller coaster been?
Yeah. So Florida has always struggled with its disaster insurance because the risk of hurricanes and disasters and storms is so high. And so that has just always made it a little bit more tricky to offer insurance coverage there. I think since 2000, Florida has had 36 presidential disaster declarations, not including COVID. And the National Oceanic and Atmospheric Administration, NOAA, has estimated that they've experienced 57 of those billion-dollar disasters that they keep track of, with costs from just the last 7 years exceeding $1 trillion. So they really do face a lot of economic risk associated with climate disasters. I think it's maybe important to start by reminding listeners, many of whom will already know this, but that to be protected financially against hurricanes, you actually have to have 2 insurance policies in the United States. We don't have hurricane insurance. So our standard homeowners insurance provides coverage against the high winds. And that's the market that we talk about in this report that has been under a lot of scrutiny and concern and in the headlines and the subject of Senate committee hearings recently because of the challenges happening. And that market doesn't include flooding. Flooding is covered separately through the federal National Flood Insurance Program, which I know you've talked about with other guests and me too, to your listeners about before. And there's also policy issues going on in the federal flood program, but that wasn't the focus of this report. In the state of Florida, about 6% of flood policies are with the private market. So the overwhelming majority is with the federal government. So I just wanted to make that distinction at the beginning.
And just clarify this too. I didn't realize this, but actually flood insurance, not a lot of people in Florida have it and more people are getting it, right? Do I have that right? Because I think with Citizens, and we're going to talk about Citizens insurance, you're required to have flood insurance, but I didn't realize a lot of people didn't actually have it at the get-go.
Yeah, they did pass. You're exactly right. Recently, the state passed a requirement that households in the public insurance program, which, we can explain right now, are required to purchase flood insurance too. So they've expanded the mandate of those that are required to buy flood. And you'd think that maybe all of Florida's at high flood risk, so maybe everyone would have it. But we know it's always a challenge to get people to purchase flood insurance and to be able to afford it sometimes too.
I'm always learning something new. And your article, your report was fantastic in that respect. But I'm trying to think of things that help people provide some context. But let's talk about the 3 state programs that actually handle insurance, because I think that's useful because even in the report, sometimes they could potentially be at odds. But what are they really quickly? You don't have to go into too much detail on any one of them, but what are those?
Yeah, let's start there. That's a good place to start. So as I was saying, we're going to be talking about the private market and your wind or your homeowners coverage. And because the risk is so high, it's been the case for many decades that sometimes residents of Florida can't find a policy in the private market, or they can't afford the policy they can find in the private market. And so the state has stepped in, like you said, with 3 different programs. So the first program is called Citizens Property Insurance Corporation. People usually just refer to it, as we have already, as just Citizens. And they provide insurance to residents of the state, again, who have trouble finding it in the voluntary market. And they've been around in one form or another for decades. The current version of Citizens actually dates to 2002 when 2 other state programs merged, but the state has had a presence in providing coverage going back decades now. And you can purchase either a full property insurance policy, like a full homeowners insurance policy, or you can buy just wind coverage if you covered every other risk through the private sector. Like maybe you have a homeowners policy that covers burglary and a random kitchen fire and all that stuff, but excludes wind. You could buy your wind only policy through Citizens. So that's the first one. And we can maybe after we go through these, talk about some of the changes and what's been going on with Citizens. But unlike any other state in the country, Florida also has its own reinsurance program. So reinsurance is insurance for insurance companies. So they buy coverage just like a household buys coverage to cover those really severe losses. And reinsurance is really important for disasters because with disasters, entire localities get hit at the same time. And so you really need to diversify those risks globally. And that's where the global reinsurance market comes in to help companies do that. But that market can also be expensive as well. And so the state provides its own layer of reinsurance to companies operating in Florida at much lower cost than the private reinsurance market. So that's called the Florida Hurricane Catastrophe Fund. So that's program number 2, and which is unique to Florida. And program number 3 is a program that I think almost every state has, which is called a guarantee association. So this one is the Florida Insurance Guarantee Association. And the Guarantee Association picks up the claims of insolvent insurers. So when insurers go insolvent, if they were in what's called the admitted market, so any of your mainstream insurance companies, then the Guarantee Association makes sure that consumers still get their claims payment and they're not left with nothing. So those are the 3 programs. Yeah, let me pause there. Doug,
Yeah.
then we get.
Just really quickly, even when I was at your conference, I still don't quite get, you have these reinsurers and then you have the insurance companies that are the first interaction with like homeowners and such. And I never quite understand why even have, let's say, Citizens. Why isn't it just the reinsurers? If they're the ones with the bigger pockets spreading out the risk, I've never understood this. Why even have those smaller insurance companies if you need a reinsurer to just back them up in the first place?
Yeah, it's a good question, actually. And I think it probably has to do with just the transaction costs of writing a bunch of individual household policies. And so you have the first layer of primary insurers who do all that contracting individually with each house and make all the payouts. And the reinsurers sit at a level above that. And so they'll reinsure like the entire portfolio of an insurance company at a much sort of higher aggregate level. And that's when they'll diversify hurricane risk in Florida with earthquake risk in Japan and wildfire in Australia and so on, to create a little bit more diversification to being able to insure those disasters. But as you noted, all insurers who write disasters have to have some amount of reinsurance so that they don't go bankrupt if there's a really bad disaster event. So it's an important piece of risk management for the insurance company itself. But in Florida, the makeup of the insurance companies is a little bit different than other places in the country. In many places in the country, the sort of big name insurance companies, those homeowners insurers firms that are like household names, they make up a lot of the market. But in Florida, most of those companies left a long time ago. And so you actually have a bunch of really small local and regional insurers that might only write in Florida or only write in the Southeast. And that means that they're really concentrated and they have a higher degree of risk. And so reinsurance for them is really important. And so to your point, they could be much more heavily reliant on reinsurance. But that means that ups and downs in the reinsurance market hit Florida insurers much, and then thus Florida consumers much more than like in other states. So and this has been a trend happening in Florida over years. So just to give you some example, these sort of more localized insurers in the industry, they're sometimes referred to as Florida specialist insurers. They're over half the market in Florida. And going back just to 2004, they were only about 20% of the market. So their share is really trending up. In addition, the big name insurance companies have created Florida-only subsidiaries to wall off their exposure to Florida. So they'll have a subsidiary, and if it goes insolvent, it won't have to impact the whole rest of the firm. And then the rest is sitting with Citizens, the public insurer. So that's a very different market share arrangement than in other states.
I want to talk about this. That was actually my next question about these smaller insurers.
Oh, and there we go.
the utter insanity about this. And just let me, first off, walling something off. I guess they don't wall off the profits from those companies when they do well. But if they go under, then they're like, oh, we're walled off and we're not going to have that liability. That's crazy in itself. And you think the opposite would be happening in Florida, where there's such huge claims that are happening pretty frequently now. You think it would be a market where like, all right, only the big insurance companies really are going to be able to do well, not the smaller ones. Because I followed it pretty well, not like you, but these smaller ones are constantly going out of business. Even with the reinsurers, they just can't handle when a big storm hits. So shouldn't literally, I understand why the big ones are leaving, but in reality, shouldn't the opposite be happening? Only the big ones with the resources should be providing insurance, because little ones are just 10 years from now, the small insurance market seems like it's going to be radically different because a bunch will go out of business. Am I wrong?
No, you're exactly right. And the Florida insurance market sees a lot more churn than other states because of that. So exactly to your point, since only 2019, there have been 10 different insurer insolvencies in the state. And all of those have gone to that guarantee association we talked about. So that state program had to pay out $1.6 billion to cover all these insolvent insurers, which is exactly right, because they are more fragile. They tend to not have as much capital. Yeah, they're just more. And so it does make you really skeptical about some of the business models that appear to not really be in it for the long term. But when you have firms like the big name insurers that are really there for the long term, have been here for many decades and are making more long-term bets, they're not willing to write in these high risk areas anymore. And I think that's where we come to the climate change part of this conversation, right? Because the risks are just getting so high and there's no end in sight. And I think that's the really scary thing for society, as has come up in many of your episodes, but also for the insurance sector right now, because they don't see the risks coming down. And when the risks are really high, that makes insurance cost a lot. And so what you have is this real tension between being able to profitably provide insurance against these growing risks at a price point that people can afford or are willing to pay. And we're really starting to reach that breaking point where the price required for insurance is just beyond the means of lots of people. And that's why there's concern about this kind of, breaking in the market.
I think we're going to come back to this, and that's why Citizens is becoming more popular because of the insanity of encouraging smaller insurance companies to do business in Florida. And tell us a little bit, I think maybe you caught, I don't know if it was in the Washington Post or something, but they did an article on Demotech, which, if I have this right, please explain. It's there to make sure that these smaller insurance companies are going to be able to do what they're supposed to be doing. They're selling these policies. They're supposed to deliver these services, but are they financially stable enough to do? Do I have that right? Is that what that group does?
Yeah. So Demotech is a rating agency, just like Moody's or Standard & Poor's or whatever. And insurance companies themselves get ratings from the rating agencies. And it has to do with, their fiscal health, their ability to pay claims, and what kind of financial condition the firm is in. And I'll note that rating is actually important, not just for the broader finances of the company, but for our housing and mortgage markets, because the GSEs, so Fannie and Freddie, will only take mortgages from higher rated insurance companies. And we know that lenders require insurance for a mortgage, a homeowner's policy. So this is where the insurance market turmoil starts to spill into housing and mortgage markets, because if you can't get insurance and from a good rated insurance company, you can't get a loan, and a lender couldn't transfer that loan off to the GSEs, which would then diminish the amount they could lend. So we have this kind of chain reaction that starts to happen. And what occurred is that Demotech, as has been observed in the industry for many years, is giving much higher ratings to some of these Florida specialist insurance companies than the more established rating companies. And so it's rating them higher. And there was a recent research paper that got some attention. I could maybe send you the link so you could put it in your show notes for listeners, that did some really nice quantitative analysis showing that for the same firm, these other rating agencies would have given it a much lower grade than Demotech. And so Demotech is, it raises it's raised these questions of, are they artificially getting these good grades when they really don't deserve it? And Demotech has been focused on these smaller companies in these high risk states with riskier liabilities. They tend to be less diversified, concentrated exposure, reliant on reinsurance. So they are riskier companies. Let me just share one story with you, because I think it also drives home some of the challenging risk management politics in Florida. In 2022, Demotech told 16 insurers that they might face downgrades. Hey, you're too risky. Your finances need some shoring up. And if that happened, the GSEs wouldn't accept houses, loans where the owner had insurance from that insurer. And the Florida legislators, some of them, instead of trying to manage the risks of those firms, suggested finding yet another rating agency that would just give them the high rating despite the risk. And a year later, Demotech had not downgraded any of them, and one had already become insolvent. And so I think another aspect of all of this that's really tricky is that politically, there's often an appetite to just ignore the risk and not address it, because addressing it can be hard and might be costly, but failing to address it is also setting us up for much higher future costs.
Okay, I'm glad you shared that, because that was what I was talking. I think the Washington posted a story just on that, and just here, this Demotech is already being criticized for not doing enough. And when they did their job, the legislators slapped them down to just put them in their place, obviously going against what they're supposed to be doing, creating some confidence in the whole smaller insurance market. It's insanity. And I think about if responsible people were designing insurance markets in Florida, if they didn't even know about the existing one, they'd have designed the opposite of what's happening now. We don't want small ones without big pots of money and backing that. It's Crazy. Anyway, I digress. I want to talk about, and I've been doing this more in the podcast, about climate modeling. And there's this Florida Commission on Hurricane Loss Projection Methodology. And it's a commission. I didn't know anything about it. And it's a body of scientific experts and agency heads that reviews and must accept catastrophe models before they can be employed, I'm assuming, by these insurance companies. What's your sense on that commission? To me, that's could be ripe for, all right, are they really churning out strong science?
Yeah, this is a really interesting arrangement. And I think one that could have lessons for other states as their risks start to grow. And I know, for example, California has been looking at what Florida did and thinking about these same dynamics in their own market. So insurance companies need to use what are called catastrophe models. I know you've had some interesting conversations about them, and they're getting more and more in the conversation as more and more people need that type of risk information. But they've been around since about 1992 when Hurricane Andrew hit, and 94 when we had the Northridge earthquake. So these big catastrophes where insurance companies realized a few years of historical data is not going to cut it to estimate catastrophe losses, the rare big events. And coinciding with our increase in data availability and computing power, these big simulation models were created that, like for hurricanes, run thousands of simulated hurricanes at the coast and then use that to create probability estimates of potential damage. You run these hurricanes with their associated wind and water at a database of the existing homes, and insurance companies use that to estimate potential losses. So what's the risk that they're going to have to pay this much in claims? And then they use those models to decide where to offer policies and how much to charge for them. And they're really important for catastrophes. They're also really important as risks are changing because the past is no longer prologue. So we really need to be able to incorporate climate changes when we look ahead. But they're black boxes. They're proprietary. They are owned by companies that charge insurers for them and don't want to give away their special sauce. So that raises a lot of thorny public policy questions about how do regulators know that those models aren't biased or aren't being used to manipulate insurance pricing in favor of the insurer at the cost of the consumer? So to address some of those challenges, long way to get to your question, Florida created this commission. And essentially, if an insurer in the state wants to use one of these models, the model has to be approved by the commission. And the model owners have to go before the commission and essentially open up the model and show them their assumptions and their methods and everything that's going on in them so that the experts can look at them and make sure that they are best in class and don't have biases or other problems. And then once they're approved, insurers can use it. I think it's actually a really nice solution to this problem where you're not going to get these companies to become open source. They're competitive, right? And at the same time, you need to assure that it's meeting public policy and consumer needs. But that's not something just anyone can do. You have to be a modeling expert to look at those. And so that's how Florida has solved this. And I will say another nice thing for researchers out there is that they do have to post publicly a bunch of different estimates from the model, like estimates of the 100-year hurricane in Florida and what the losses would be. So you can look across these and see the variations in the models and get a real good sense of hurricane risk exposure in the state. So they also do make some of that public.
All right, that's encouraging here. I had no clue about that because when I do talk about some of the climate modeling, we do talk about this whole black box and people not really understanding what's under the hood there. And if this commission is there to look at that's great. I obviously have my skepticism of who's on the commission and does it do a good job of really factoring in climate change projections, because the state of Florida is notorious for not wanting to think about that. And I'm sure they must have scientists on this thing, but they probably have political appointees too. And yeah, anyway, has anyone done an assessment of the commission?
No, I was going to say those are really good questions that I don't know the answer to. I don't have a good sense of who's on it I'm sure there's some other experts in Florida we could track down to answer those questions.
All right.
Interesting. But actually, I wanted to add one more thing on this topic, because I know it's one that you and your listeners have been thinking about too, which is that besides the commission, Florida also created their own totally open state catastrophe model that's housed at a local university. And I think that's also a really interesting and nice lesson. And they use that as a benchmarking as well for the private models. And it also gives the CAT modeling capabilities to any researcher or policy question in the state. And I know there have been a lot of discussions in the climate adaptation community about the need for something like that, maybe more federally or nationally, to make sure that there's transparency to everyone who needs it about risk information. So that's maybe another, lesson from Florida that would be a positive one instead of a negative one.
All right, we found one, the positive story. Okay, in the report, and this is something, and maybe I read the report, but to me, the emphasis was really on hurricanes and maybe these storm events, but hurricanes came up over, and I didn't necessarily see, and you talk about climate change, and it's obviously noted in this, but sea level rise and how that's going to factor in, and just, you have a lot of recommendations and these are solutions such, and I didn't necessarily see the bigger acknowledgement of sea level rise is just going to radically alter this. Like there's, that's just going to complicate things. Let's just focus on the hurricanes. And I'm not saying that about you, I'm saying about Florida and its insurance. But if we truly were factoring in sea level rise, a lot of these conversations would be even more different than what we're having right now. Does that make sense?
Oh, totally. And yeah, sea level rise risk in Florida, as you just said, is such a huge problem. And I think I saw an estimate that like half of the US population exposed to sea level rise this century is all in Florida. And I think to your point about where that's hitting, a lot of that is driving increased flood risk, which would be in the flood insurance program, which we didn't talk about as much. But it does, to your point, have some spillover into the wind portion as well, because as the sea rolls inland, then storms are getting further inland as well. And that all, of course, causes similar problems. And it also just gets, though, to, I think, the really thorny challenge in Florida, which is a lot of development in areas that are going to be underwater or face really frequent flooding or very serious hurricane risk. And how do we start thinking about changing land use patterns to safer arrangements?
And so I get, but I guess what I'm getting at too is just even responding to like the status quo on hurricanes in Florida is so difficult for them. Everything you've spelled out in this report and how difficult it is to get insurance companies, you add even 6 inches of sea level rise to that. That's going to radically alter even how hurricanes are going to impact these areas. And so are these insurance companies even really thinking about that? It just, they can't even deal with the status quo of the hurricane situation, let alone like the projected. Yeah. And in your paper, obviously you cover a lot of ground, but I felt like partly there was this acknowledgement. Okay, managed retreat is really the only way to minimize what's going on in Florida. And I guess you didn't quite get there.
Yeah, we did not get into managed retreat, but I think your assessment is completely fair. And to add on to the climate challenges beyond sea level rise, I reviewed some of the recent climate science publications on this, and a lot of dimensions of hurricanes are also getting worse in a really scary way. Like that rapid intensification is becoming more common. We're seeing hurricanes stall more, where they drop all that rain like we saw in Harvey, which just causes enormous flood damage, and slow down their dispersion so they stay terrible storms for longer. And also there's some research showing that getting more storms in quick succession, the odds of that are also increasing. Yeah, the increasing risk is incredibly sobering. And I think that recognition of that is what's driving some of insurers away from the state in advance of that. But you also get to another point, which I just want to unpack with you for a second, because I think it's important in thinking about our insurance market and what it can and can't do and what we should be asking of it, which is that insurance prices are for just this year. But we're right, like they only price for the risk of the contract period, which tends to be 1 year.
Right.
Risks are going up year after year. And so we see requests for rate increases and that type of thing, and these kind of volatile dynamics in the market because, to your point, climate is driving up these risks. And I don't know that we're doing such a great job, certainly not through the insurance market, but even through any other policy structure, in really making clear to people how that risk is changing over time and what it means for them. You're moving in here. Okay, you got your estimate of your insurance cost, but it's just going to go up. That's your low bound estimate. 10 years from now, you should be expecting it to be even higher. We don't seem to be having those conversations. Or do you see those conversations happening?
Oh, not so much. And that your point is like when I was at your conference, I had some side conversations with insurance types, and that I didn't quite get that. I didn't understand that the sort of the short-term nature of the actual contract versus, the insurance companies want to be responsible and think 20, 30 years out, but like, all right, but our contract is for the next year, and they have to juggle those two realities. That's a difficult position to be put in.
Yeah. And I think it's also limiting what we'd want the insurance market to be doing, which is creating stronger incentives for people to invest in risk reduction, right?
So I have a few other questions in the weeds, but I really want you to take a crack at these. And when I lived in Florida and I go back all the time and I see, okay, people moving to Miami and people live in Sarasota, Florida and all that. Okay, their insurance is going to be very expensive. It's going to go up. Good. That's the market acting in rational ways. But then places like Orlando and Central Florida, that some of them, their insurance is going up quite a bit. And it's ultimately because they're helping subsidize the overall insurance market, right?
Yes. And actually, that raises two issues that it'd be great to talk about. The first one I'll just quickly flag and then get to the cross subsidies that exist in Florida, which is, yeah, we want rates that reflect risk to send those signals, and both financial and risk signals. But that does raise this challenge of making risky areas then very expensive to live in. And in Florida, where your risk is almost perfectly correlated with amenities, like the beautiful beaches of South Florida, then that makes it so that low-income people are locked out of access to living in those high amenity areas. And so there's some important equity dimensions to this that really haven't been solved. Let me bracket those for a second. And now talk about this cross-subsidy thing, because this I find crazy in some sense. But on the other hand, there aren't a lot of policy proposals for what to do differently. But so what happens is that these three programs in Florida that we talked about earlier, Citizens, the Reinsurance Cat Fund, and the Guarantee Association, none of them are designed to have enough money on hand to pay the claims from a really bad event. So a really severe storm or a series of storms in quick succession would quickly exhaust the available money, say, that Citizens has to pay claims. And what it's designed to do when that happens is go to the bond market and take on debt. So it borrows and then pays the debt back by assessing policyholders after the storm. And for a smaller storm, and this has happened before, they assess their own policyholders. So in this way, the costs of insurance are spread out after the storm as well as before the storm. So the prices in Citizens are too low in some sense for the full risk, and they recoup that afterwards. But if that assessment on its own policyholders isn't enough because the storm was really bad with huge damages, then they put an assessment on every insurance policy in the state with very few exceptions. The exceptions are they can't assess our federal flood program, and I think workers' compensation, maybe medical malpractice. Every other policy gets put a tax on it afterwards to pay the claim. So big hurricane hits Miami, your business policy and your auto policy in North Central Florida are paying those claims after the fact. And just one more point, it's not just Citizens that does that. The Guarantee Association and the CAT Fund have the ability to issue assessments in slightly different structures, which means, and they're all correlated, which was a big point we were trying to make in our report, is that each of those programs is managed independently. But a really bad event or series of events is going to cause all three to go into deficit at the same time. And then you could get a clash in the bond market and stacked assessments on consumers afterwards. So it's a big risk.
Okay. And I remember that part. But I guess my question, though, is that when I think of, you're living in Gainesville, Florida, and as you just described, your rates are going to go up because they're trying to spread out this risk, and especially even after the event. Aren't there laws in play? I don't know if it'd be federal, and I'm sure there aren't state, because Florida's always looking to just stick it. But you are living in Gainesville. You are being responsible. You haven't gone to the coast. Isn't raising that person's rate a form of price gouging because you don't have as much risk, and yet they're raising your rate? That's price gouging.
That's really interesting. And we need an insurance lawyer to come weigh in.
Okay, all right.
Most states have a law that rates have to be fair and not discriminatory. And what they mean in those laws is related to the risk. So lower risk people should have lower prices and higher risk people should have higher prices. And yeah.
I was just going to say, and I think that's true. If you live on the coast, you have higher rates. But as you just described, they're still elevating other people's rates. As I think that's what you said, just even these post-storm events. And they shouldn't be for you're living in Gainesville, Florida. You're still not going to have the payouts, of course, if a hurricane dumps a bunch of water on you. But it seems like a form of price gouging.
It's definitely a cross subsidy from lower risk inland areas to the higher risk coastal and southern parts of the state. Absolutely. I think that's a really interesting question about what that means vis-a-vis our laws about fair pricing that I hadn't thought about before. If I get an answer, I'll come back to you.
Please do. And I can imagine just there's people at the universities in Florida, they must think about these things all the time, but just it doesn't get out. And if I was just a city in North Central Florida, I'd be outraged that your rates even go up 1 cent based on the risk that these coastal people are putting themselves in. It seems like an outrageous thing. In the article, you use this language to achieve longer term stability. And some of the recommendations, you even talk about homes that can be built to withstand certain wind capabilities. And there's concrete things that you can do to make these areas more stable. But that goes back to my point. In the event of a hurricane, as a society, not just the state of Florida, why do we want these people to live in this high risk area at all in the first place, as opposed to giving them some pathways to make it a little less risky?
Yeah, I think this is going to be the big question of the coming years, right, Doug, about relocation and migration and where we can continue building and living and where we can't. And I think a lot of it comes down to that fine balance between where the risk is and the costs. And you weigh that against the benefits of being there. And some of these places are, like we were just talking about, getting the expected damages are beyond what people can pay, or the cost to keep rebuilding them is more than the value of the property. And it just really starts to become uneconomic to keep living there. And we need to keep working on better public and private, exactly as you said, pathways for people to find safer and cheaper places to live in the face of that growing risk. And I think part of that conversation now needs to be about, what does an insurable community look like? What do we do at the level of a community to maintain a stable and affordable insurance market? And some of that's going to be saying the highest risk areas don't have development. We can't develop there in any sort of cost-effective way.
And listen, people are having these hypothetical conversations. It's not even just develop there. It's like even existing people there shouldn't be living there. And those are the sort of difficult questions. And again, back to that managed retreat. And so again, I want to put you on the spot here. I read these things and I've been exposed to like citizens insurance for a long time. And in a rational market, citizens insurance wouldn't even exist, right? It'd be like, okay, no, the private sector, they're leaving and it's responding to the realities of the situation on the ground. And yet it's this artificial thing, citizen insurance, giving people a backstop or whatever to do it. And this is the cynic in me. And as you described in this article, all three different groups that can provide insurance, if a major storm like 2 or 3 hit, they're all going to be wiped out. And if the worst case scenario hit Florida and citizens is no way can pay for it, the federal government's going to come in. And I think this Florida legislature, the governor, the insurance companies, they all know this. And so this whole idea that you need these reforms here and the federal government is still going to come at the end of the day and bail them out. And do you agree with that?
Yes, I do agree with that. And I think the question of the role of government at both a state and a federal level in subsidizing the risk costs of different locations is one we need to quickly get a handle on. And I think there is growing recognition of that. As we noted at the top, there's been some Senate hearings, for example, on this and on Florida, I think, with recognition. And we've seen in years past, not recently, but in past years, for example, the Florida delegation has wanted the federal government to agree to back their bonds. We were just talking about how they have to issue all these bonds afterwards. So they're clearly aware of this and hoping for federal roles. And we've seen legislation introduced just this year that would essentially put a federal backstop, like we do for terrorism insurance, for natural disasters. So I think this is an important question, but I want to zoom out for 1 second to just unpack some of the trade-offs a little bit, because on the one hand, we need to, I think you are exactly right, that we need to view the crisis in our insurance markets as a signal for how high risk is, and that we have to invest aggressively and quickly in much more climate adaptation in order to lower that risk to a manageable level. On the other hand, if we do that by just letting insurance price risk, what will happen is lots of people will just go without insurance before they do any risk reduction, before they move away, before they invest it in mitigation, and especially lower income people that might not have the means to do either. They'll just be without insurance. And we know from other research that what happens when people don't have insurance is a lot of pain and suffering. And people don't recover for years and years. And it can be a cycle into financial precarity and poverty in all sorts of incredibly upsetting ways. And so insurance also, though, provides this broad social benefit, and we want people to have access to it. But we don't want to provide them access and keep them in risky areas. And so how do we make sure that people have financial protection and yet are on a path to safety away from high risk areas? So how much do we subsidize the risk by the public sector? How do we target those subsidies? Over what time frame? I don't think any of that's been well answered yet.
Yeah, and I think those ideas, I've had this discussion before on the podcast, is that two ideas that are very at odds: poor people not having access to insurance, and like you said, they'd be the first ones to go without. But if you were to provide subsidies, provide a system that allows them to stay in their home, it's just, but the bigger question of, should anyone still be living in these areas? And there's 6-7 feet of sea level rise coming to Miami. These are starting to become like the conservative estimates. There is no adapting out of that. They'll try, they'll create some big giant pumps and such, but it's subsidizing a system where people are going to stay in an area that to me, it's just nuts. And that's what's going on right now. Yeah.
And I'll just riff some more with you. It's my personal feeling that to do that well, that movement from the coast that's going to be required in the face of the sea level rise and the changing storm risk that's coming, requires really a strong public sector hand, sound policy architectures, and probably also funding and good incentives. And so we need good government, and to get there, we're going to need bipartisan leadership that we are just not seeing on this issue, which is really frustrating for me. But
I just had Mark Nevitt, a law professor at Emory, on. He was my previous episode, and we talked a bit about the recent Chevron decision out of the Supreme Court, and could that undermine the government's ability to do adaptation, and probably will be. And so we're heading in the opposite direction. Instead of even providing more tools, we're taking tools away. But as I have said, climate change is like gravity. There's no arguing with it. It's just going to happen.
Exactly. And I think we need to figure out ways to more broadly link the conversations about what's happening in insurance markets right now and what's happening with disaster risk with that ultimate risk management of lowering our emissions. And so we need all the adaptation, of course, but we also need it to be informing strong climate policy.
All right, Kellen, this obviously excites me. I love talking about these topics. Fantastic report. So any kind of summaries or anything, wrap-ups you want to say?
I think we covered a lot of the big points. Risk is growing. We need to be working to reduce it, and we need to be having the tough conversations as well about how we're socializing that risk and what the outcomes of that are going to be.
Before I let you go, what else are you working on? What's keeping you busy there at EDF? What's on in the next 6 months for you?
One project that I think is related to some of the things we talked about, that need for greater risk reduction, is where can the insurance sector help with that? And so we're starting to explore some models where you could have add-ons to your insurance policy. So at the time of rebuilding, you get more dollars, but also really targeted help and guidance to build back stronger and more resiliently. And in my dream vision, to also decarbonize the building sector at the same time. So to have this much better rebuilding process than we do right now. And the part that's going to be difficult to work out is exactly what you raised, is how do we, after a disaster, if people are fed up, the risk is too high, and they want to move, how can they take their insurance payment and get to somewhere that's safer, but not have it so that someone else just moves in after them? So how do we do that conversion into open space or whatever is going to be needed to lower societal risk? So I'm excited about exploring some of those models.
Cool. All right, last question. If you could recommend one guest to come on this podcast, who would it be?
So you and I have just now been talking a lot about insurance policy and regulation and markets, and focused on Florida. If your listeners would want to think more about the intersection of insurance and adaptation, but in a different location that's also really being hit hard right now, and from more of a community and household perspective, I would probably suggest Jessica Dandridge. She's the executive director of the Water Collaborative of Greater New Orleans. I met her as she's co-chair for the Resilient America Roundtable, and just has a really insightful perspective on how all of this is playing out on the ground in Southern Louisiana. So yeah, I'd recommend her.
All right. Fantastic recommendation. Carolyn, it is always a treat having you on. I enjoy these conversations tremendously. Thanks for coming on.
Thank you, Doug. I love talking to you.
Okay, adapters, that is a wrap. Thanks to Carolyn for coming on the podcast. I can't believe how excited I get talking about insurance markets in Florida. But there you have it. As Carolyn shared, Florida is in a precarious situation regarding its insurance markets, and it's only going to get worse. I certainly don't know what the solution is for communities that are pricing out people to even afford property insurance. The larger discussion of managed retreat needs to happen soon, so this doesn't just happen piecemeal over the coming decades. Is it climate justice to help people afford to live in at-risk zones where the danger is only increasing? Is that climate justice? Or is it more appropriate to find financial pathways to get people, both rich and poor, to move away from these increasingly at-risk areas? And I especially enjoyed our discussion about the federal government's role in financially bailing out places like Florida. That's why all this legislative shuffling in the insurance markets in the state legislature seems so disingenuous. If you know the feds are ultimately going to bail you out, then you likely won't make the necessary and even potentially radical reforms in your insurance markets. That's why you see these smaller boutique insurance firms still thrive. The unspoken word is that the feds will bail you out if the truly big one hits. That's not fair to U.S. taxpayers. Okay, if you want to read her paper, a link is in the show notes. And definitely check out Carolyn's previous episodes on America Adapts. Those two are in the show notes. All right, you've been waiting for it. This episode's hot take. And for those who aren't familiar and haven't heard me do this one in previous episodes because it's relatively new, a hot take is a controversial opinion that has no factually right or wrong answer. It's a knee-jerk response to an issue. Here's my hot take. It's not fair for inland communities in Florida to subsidize through higher rates people living in coastal zones. You just heard Karen and I discuss this issue. So to discourage this behavior, coastal communities should pay an additional fee in their insurance that will go to subsidize those living in safer inland areas. Yes, these coastal zones already pay higher fees. Tough. An additional fee that will go toward an inland property fee reduction will make it more attractive to live there and further create disincentives to live along the coast. We need to get serious about discouraging people to live along the coastal areas and encouraging people to live in less at-risk areas. Oh yes, I know this won't be a popular idea in coastal communities, but hey, that's my hot take for this episode. Enjoy, and let me know what you think. Okay, adapters, imagine the potential of showcasing your achievements through a widely acclaimed podcast that boasts a large network of climate and adaptation professionals. Yes, I'm talking about America Adapts, and how it offers your company or organization the perfect platform to tell your adaptation story and spread your message to a diverse and highly influential audience of climate professionals. By sponsoring a whole episode, you not only have the chance to share your story with the world, but also integrate a podcast episode into your organization's long-term communication strategy. I don't know how many organizations I talk to haven't even considered doing a podcast. It's time to expand beyond the confines of webinars and white papers, which can often be dry and forgettable. Let's work together to closely identify the experts who best represent the remarkable work your organization is undertaking in adaptation through the power of podcast storytelling. This will not only enable effective communication with your members, board members, and funders, but also leave a lasting impact. The value of podcasts lies in their ability to continue promoting your story long after their initial release, ensuring it remains a critical educational resource for years to come. I have episodes that I did 5 years ago that still get good download numbers. I've collaborated with prestigious partners such as Patel, the Department of Defense, NRDC, University of Pennsylvania Warden, World Wildlife Fund, UCLA, Harvard University, and many more. Let's add your organization to this esteemed list. Yes, we can make a significant difference in the world of climate change adaptation. To learn more about the enduring value of podcasts and how they benefit your company or organization, email me at americaadapts@gmail.com. Also, if you're interested in having me speak at a public or corporate event, please reach out. I've been doing some keynote presentations. I share stories from my podcasts and my own experiences in adaptation. It's also a pep talk about what we're all doing here. These are sobering times, but also very exciting times in the adaptation field. It's such a new emerging area that you can influence the field. Let me help educate your audience on this emerging adaptation sector and how it differs from carbon mitigation and sustainability. Your companies and organizations, and especially your leadership, need to understand these differences in the years ahead. You can contact me at that same email, americaadapts@gmail.com. Okay, adapters, keep up the great work. I'll see you next time.